If you follow the standard advice to get good grades, land a safe corporate job, and save 10% in a bank account, your financial growth is limited by the number of hours you can physically work. When the math is based on a fixed hourly rate, the system eventually grinds to a halt. The hardest working people on Earth are often the poorest, while those generating millions may spend their Tuesdays playing golf. The ultra-wealthy achieve this by ignoring hourly rates entirely. They focus on building systems that decouple their income from their physical labor. Grab a pen. You should not quit your job tomorrow. In fact, right now, your employer is acting as your very first angel investor. Your current salary is the seed capital required to start this process. We are moving past motivational quotes. I am going to walk you through the actual financial mechanics of wealth creation, step by step, so you have a concrete framework to acquire your first true asset. There are two entirely different economies operating side by side. The first is the employee economy. Here, you operate on earned income. You are trading a strictly finite, non-renewable resource, your life, for currency that loses purchasing power every year. Time multiplied by an hourly wage equals your income. With only 24 hours daily, your earning potential hits a rigid ceiling. Now, this morphs into a pie chart of employee taxes. Taxes taken before your paycheck. You earn, the government takes a slice, and you spend the rest. The owner economy operates under different rules. Wealthy individuals focus on portfolio and passive income. They build businesses or acquire real estate, entities that produce value independent of the owner's physical labor. This flowchart breaks down the owner's legal tax advantage. Governments prioritize job creation and housing, so they reward owners. The sequence shifts. You earn, you spend by reinvesting in your assets, and the government only taxes the fraction that is left over. Operating as an employee enforces a strict mathematical limit on your net worth. Operating as an owner provides legal shields and the ability to scale. Many consumers destroy capital by immediately purchasing liabilities. These are things like luxury cars or designer clothes that take money out of your pocket every single month through maintenance, insurance, and depreciation. An asset has a different function. It is an entity that consistently deposits money into your pocket without requiring your daily labor. This brings us to the golden rule of wealthy consumption. Assets buy your luxuries. You should avoid using active income or savings for luxury purchases. An owner buys a cash-flowing duplex that generates $2,000 a month in profit. They route that profit to pay a sports car lease. When the lease ends, the liability disappears, but the duplex remains, continuing to generate $2,000 every month. The wealth gap expands when people use specific financial mechanics, like this loop, to fund their lifestyle rather than relying on a salary. If you only use your own money and your own labor, you will eventually hit a wall. To grow wealth beyond your individual limits, you need leverage. This diagram shows the first multiplier, other people's money. The wealthy use good debt by borrowing from a bank at a 6% interest rate to acquire an asset that pays 12%. The asset pays off the loan, and the owner keeps the difference. Borrowing to buy consumer goods is a drain on your wealth. Leveraging debt for a tenant-paid asset is a method of tax-free growth. Because loans are not classified as income, taking on debt against your assets incurs zero income tax. The second multiplier is other people's time. You must buy back your personal hours so you can focus on strategy rather than daily operations. You build systems. You utilize software, artificial intelligence, and specialized teams to execute the repetitive tasks. The systems run the machine, leaving you free to focus on acquiring the next asset. Applying these leverage multipliers creates the difference between earning a 6-figure salary and building an 8-figure net worth. Now you must build your own engine. Map out your very next paycheck. A percentage of that money is capital meant to buy a piece of the owner economy. You have 3 ways to start. Option 1 is broad market growth. Set up an automated recurring purchase in an S&P 500 index fund, making you a fractional owner of the largest companies in the country. Option 2 is funding a digital side hustle, a project designed to scale online, processing sales without your constant manual presence. Option 3 is real estate. This involves setting up an automated savings transfer specifically to aggregate a down payment for a cash-flowing rental property. Log into your bank or brokerage account today. Lock in this automated transfer so the money moves before your next pay cycle ends. Executing this single automated step converts your day job into a temporary wealth-generating engine. Setting up these automated systems means you have officially shifted sides. You have moved from working for money to acquiring assets. This chart tracks the mathematical tipping point. You reach a new state of stability the moment your passive cash flow from your assets surpasses your basic living expenses. Crossing that line changes your relationship with work. You gain the ability to choose whether to clock in or permanently walk away. If this breakdown was helpful, hit the like button so the algorithm shares this financial education. Subscribe to the channel and drop a comment below letting me know, what is the very first asset you are going to focus on building this year? Permanently decoupling your survival from your physical labor is the final state of this system. I'll see you in the next one.